Today, I'm going to show you one of the most efficient and accurate trading strategies that I was taught by my professional mentors. And if this video ever gets 50,000 views, I'm just going to delete it because, well, I still want it to work. The strategy I'm going to show you in today's video centers around option flow. It's incredibly complex, but I'm going to make it as simple as possible. It has gotten me to where I am today as a profitable 20-year-old trader who works alongside some of the world's best traders. I'm very lucky to be where I am today. There's no doubt. And so I feel an obligation to share the knowledge that was passed down to me by my mentors. So if you're tired of draw a line and make money trading strategies you see all over social media, this should be a refreshing wake-up call to you. Because believe me, drawing a line is not going to beat a $100 trillion market. But what I'm going to show you today does. So what is option flow? Well, option flow is just simply the individual option orders that print throughout the day that we as traders can see. Specific orders can provide us with valuable information to taking action and finding edge in our trades. But before we get into all of that and how to actually take trades with option flow, we first have to understand, why does this actually even work to begin with? That answer is found within the relationship between options and the stock market, which if you have any hope of being a proficient trader, you need to understand. Now, I'm going to go out on a limb here and say that majority of the people watching this video right now, whether you trade stocks, futures, or hell, even options, you've probably discounted how important options are to actually moving the stock market. Here's a newsflash. Options actually dictate where stocks go. Yes, even if you're trading futures like NQ or you're trading stock equities like Tesla, options are dictating where that goes, which means you've probably been trading these things all along, not really knowing where they're actually gonna go. What? Huh? How does that even work? Well, it gets a little complex, so buckle up. Over the last 10 to 20 years, we've had a huge revolution into US equities. Everyone and their mom is buying stocks. We've seen this all around the world. Foreign investors, local investors, billions, trillions of dollars is being poured into the markets like never before. And with this huge rise of equities, you also have a huge demand for hedging, that everyone's long in the world, so they need instruments to hedge their risk and reduce it for those clients who are investing. So naturally, what these firms will go and do, and market participants, is they go out and they buy options, things like puts or calls, to hedge their portfolio. And we've seen the demand and activity in options exponentially rise over the last 10 to 20 years, which at first this might seem completely useless until you really figure out that there's two sides to a trade. While someone's hedging their portfolio, well, guess what? The other end of that trade, the market maker who's selling these options to you, also has to do something to control his risk. And here's where things get really interesting. To control their risk, market makers who are selling these option contracts, they're going to buy or sell shares depending on what contract they sold to you. I have a wonderful video here, you guys can feel free to watch it after, that explains this way more into detail, but I'll summarize it for you. When market makers are selling puts to the public, they're going to be shorting shares. When they sell calls to the public, they are going to be buying shares. Because with selling options, you can theoretically take an infinite loss. So they need to do something else to help balance that out. And the only way to get more directional exposure like that is to buy equity or sell equity. Now, let's say everyone in the market starts buying a lot of puts because they're scared of some news headline that came out. Well, guess what happens? The market makers who are selling all of these puts, they're going to be what? Shorting shares to hedge. So the market maker goes short all these shares, but options don't keep their value forever. As you get closer to expiration, you have multiple factors extracting worth out of those contracts. You have things like time value. How much time is left till expiration? Well, if it's not much time, it's going to be not much time value in the contract. Thus, it's decreasing into expiration. Or how much is the implied volatility? What is the expected move into that expiration? Closer and closer to that expiration is going to decrease. So you're going to have that value pulled out as well. And guess what? When puts lose value, market makers need less hedges, which means in the case of puts, they shorted shares. So what do they do to exit it? They start buying shares back. And so over a longer period of time, if you actually look at this, you see the markets always being supported by market makers because everyone's always scared. They're always buying puts, and the market keeps going higher because the market makers keep having to buy back shares, which creates this passive machine in the background of the market, always supporting it. Now, it is also worth noting that calls do affect the markets as well. However, they have a slightly different effect. As more people buy calls, the market maker is going to continue to long the stock. However, the higher it goes, the more they start to actually sell the shares. So naturally, a bunch of calls in the market make it harder to grind higher. That's why the saying, the markets take the staircase up and the elevator down. So now we come full circle back to option flow and what my mentors taught me. By taking this broad market concept of how options influence stocks, you can actually take this understanding and apply it to specific stocks and orders. By utilizing a specific set of criteria, which I will show you in today's video that was taught to me by my mentors, we can narrow down which orders are likely to move the underlying stock. And what's so tremendously valuable about Optionflow is not only do we get a by when we can expect this move to happen because options have an expiration date, but also which direction it's likely to go because we understand what market makers are likely going to do off of that order. We get when and in which direction, which is the two biggest puzzle pieces to creating a profitable trader, someone with good timing and good direction. So now we're going to talk about exactly what website to use, but also the different settings and the general concept of how we should be screening for these specific orders on Optionflow. But first, let me be very clear. Options do not account for every single little movement in the markets. There are some movements that are caused by news, overall sentiment, things like that. But options do create a massive influence, particularly on individual stocks, which is what we are going to be looking for today, as that is where the less money is. Majority of the money in the markets is in the overall exposure. But when you go down to individual stocks, there's much less money in them, which means that specific orders we see will likely have a greater impact. So first of all, what website am I going to use today? I am not sponsored by this company, nor do I necessarily support them all that much, but I do use Black Box Stocks. I believe they truly do have the best screener for scanning options, which we will talk about. So definitely try to use this if you are going to follow along. Additionally, you can get exposure to the Optionflow orders I find on the RADER Report. This is where I release my weekly research every single week along with other live data tools, etc. But I always find, filter, and explain all the flow that I see that I think is the most edge. For example, this trade on Wayfair, this put order came in, likely to drag the market higher, and that's what I was talking about. And on cue, Wayfair absolutely pumped. So why should you even use a website like Black Box Stocks or even the RADER Report is because 99% of flow is useless. You need to have a filter, whether it be me doing it for you or Black Box Stocks and learning how to do it is going to help tremendously because 99% of flow is completely useless because they do not understand what the purpose of flow is. The purpose of flow is not to find those who know more than us. We're not looking for people who are more intelligent, who are insiders, who are trading off information we don't have. We are looking for trades that are going to likely cause a reaction in that stock based off of that order. And those two type of trades that we look for are called discount trades, where we follow the intended direction of that order, but also hedge trades where we actually bet against it. And both of these styles of trades are found underneath the same filters, which are created from this kind of model right here. Before I show you specifically the filters that I set for Black Box Stocks, I want to show you this model, which is what kind of shaped the filters that I choose to select. The first factor is going to be premium spent. 200K to 2 million I have found to be the sweet spot range for finding orders that will likely cause a reaction. And why is that? Because orders that are too small are not big enough to cause a reaction. If you're spending at $1,000 on a stock on snow, you are not going to move that stock, but bigger orders will, especially when they're more aggressive. And likewise, on the other end of that spectrum, if an order is too big, it's likely not going to move. It might bog the market down, and it's probably not going to cause something because you put a target on your back for market makers to punish you. My mentors said this to me, and this has stuck with me for the rest, and it will stick with me for the rest of my life. Big money is not smart money. Smart money is sneaky money. Smart money is intelligently placed and timed. When you have a huge order, it doesn't mean it's more important. That is something that retail traders cannot wrap their heads around. And that moves me to the next point, which is, of course, the ticker. The ticker is very important because if we have, let's say, a 500K order on SPY, that doesn't really mean anything. SPY is one of the most traded assets in the world alongside Tesla and NVIDIA, so we don't really want to consider those because 500K to NVIDIA is nothing. But 500K on a stock like CAT or 500K on a stock like Snow is going to be incredibly influential because those are not highly traded option stocks. Therefore, it's going to take a bigger toll and a bigger reaction from the market makers to balance that on that particular name. So tickers that are unique and unusual, but also don't have excessively large market cap or trading volume are going to be our target. And the other factor you want to consider is sweep and block orders. Now, sweeps are the preferred one. Sweeps are more aggressive and they also show a sense of urgency that you're getting in, you don't care what price it is, and that's going to cause a faster reaction from the market makers. Additionally, we also look at expiration dates. The closer the expiration, the more important it is. Typically, we want to look at something like a weekly contract, something within the next 3 weeks. We also do look at monthlies, but understand that monthlies do kind of wash out because monthly expirations are very crowded. So we want to look at something that's not in a very crowded time, aka weekly contracts. While we do look at option flow that is longer out in time, majority of the times they are not as effective. You will see people on X, on social media, posting about how they found an order for a year out and how bullish it is. That does not mean anything. Market makers are not going to be moving a stock based off a contract that was just placed for a year out. It just does not create the same urgency as something closer expiration does. And lastly, the strike price. The strike price is incredibly important for a variety of different reasons. Number one, if a strike price is placed in the money, way outside of expectations, let's say I have a $500 stock and someone buys the $100 call, that does not mean anything to us. A market maker is not going to have an urgency to balance these different orders because they're outside of expectations. And likewise, with an out of the money contract, if we have a $100 stock and you're buying $250 calls, that does not make sense. The market maker is not going to make a huge move off of that because it is outside of the expected range for that expiration. So we want to find something that's really close to price, that's aggressive, that is something that the market makers would react to. So we want to find flow orders that are around between 200K and 2 million. We want to find them that are close to expiration, preferably some sort of weekly. We also want to find a ticker that is unusual, that isn't necessarily that common, that big of market cap, something not like SPY. We want to find something that's preferably a sweep and also that is a decent strike price at the money or just slightly out of the money, but still within expectations. What we do not want to find is a flow order that is coming into earnings or news. If the expiration of that kind of contract runs through earnings or is very clearly an earnings trade, we do not consider that. That is a low edge trade because, again, market makers are going to be balancing things differently ahead of earnings, and it's not likely something that will be of much importance. Likewise, with news, if news just came out and you see a flow order that still meets the criteria, also print, it's still irrelevant because it was placed because of the news, and the news is going to have a different underlying impact that we may not be able to take advantage of or understand fully. All right, now I know I just walked a mile to get a glass of water, and I did take you along the long route, but that's how I teach. I want you guys to fully understand everything behind the thing that I show you. And so with that being said, we can now move on to the filtering and actually scanning part of this video. How do we actually find flow orders? Well, on Blackbox, which I still believe is the best platform, not only because they give you historical option flow, where you can go back and see flow in the history, which will give you a lot better kind of scanning ability, because if you miss a day, you can still go back and find that order and things like that. But right up here in Blackbox, you want to click this right here, and this will pull up a kind of menu with a variety of different checklists. So the first checks I always have are, of course, we want to show puts and calls. You can always toggle these off if you want. But the next key one is going to be yellow. Flow colors, yellow, white, and magenta, these have different meanings. Yellow is the most important because what it means is that the open interest on the underlying strike price was exceeded with one order. Now, what does that mean in simple terms, layman terms? It means there was no one sitting there, and then all of a sudden, someone with a big order just sat down right on top of it. It exceeded the open interest when it placed that order. That means it's a fresh, new order that took over a fresh spot. The reason that's important is because that means it's more likely to be reacted to by the market maker. If he comes in on an untouched territory, on an untouched domain, and places a big order, that's something that we want to take note of because that shows aggression, that shows something is likely to happen there because it's new, it's dominant, it's on something that wasn't touched before. So always check yellow. I do not do white or magenta. Likewise, you want to do bid and ask. I typically do above ask and only at or above ask. Now, you can check below bid or at or below bid. That is a different flow style. Today only, I'm showing you two types. There are multiple types of flow trades we look for, but there is two that I'm showing you today. The reason we keep at or above ask checked right here is because this kind of guarantees that we're getting buy orders. Typically, sell orders are filled at the bid or below bid, and buy orders are filled at the ask or above ask. And so this helps us find only buy to open orders because we want to find the buy to open orders. Because if we find those, that means it's likely going to be a market participant, and that means that the market maker is going to be on the sell side of that order. So he's going to be the one selling the contract, which means he's going to move it with the underlying equity. If we were to see orders that were sells, that also there would mean a reaction, but it's different from this. So particularly with this one, we only want to find buy to orders as that takes a lot of the headache out of it. Now you can leave all of these unmarked. You can also check sweep only. Like I said, that will help us find some different orders, so we can read that. But sometimes I like to look at block orders. There are occasionally good block orders that are worth taking. One being, we'll show an example later, being XBI. So we'll check that one. Now this is important. This is one of the most important, is value and premium. We want to, of course, uncheck 500K. Now I have 100K because I'm advanced and I know what specific orders to look at. There are occasionally orders worth looking at that are under 200K. But for the most part, you can just have this checked and you'll do just fine. You also want to check below 0.75 market cap. We do not want to look at the mega companies. We don't want to look at Tesla. We don't want to look at Nvidia. We do not care. And the reason being is they are the highest traded derivative stocks in the world. Half the flow you see is going to be day traded the next second. It's going to be sold, bought, shared, blah, blah, blah. It's going to be so much activity you can't keep up with it. It does not mean much at all. The options on those do not affect it as much as you think it would because of how highly day traded it is. You also can select ETF and stock. I would recommend just clicking stock for now. And then if you want to look at ETFs, just privately select that just to keep the number of orders we're looking at down. You keep all of these selected, of course, including expiration. Expiration is important. We want to look at up to weekly. So now that it's the 23rd of January, I'm going to go all the way to the 14th of February because that is still a weekly. I'm not going to go to the monthly because that can be a very crowded expiration. Again, whenever you see a monthly order, it's likely to lose a little bit of its attractiveness because it is not a weekly, which is a less crowded strike normally. And again, when it's a less crowded strike, it means that there's more likelihood that a market maker is going to react to it. If he's the only guy on the chain, they're going to react to him. That's what we want to try to find. So that's what I'm going to select here. And then once you do that, you can press save or apply and you will find the orders here. And I just need to press flow here. Now you can screenshot this criteria here, maybe minus this one or maybe under or minus one of these. But in general, these are the parameters you want to set. Screenshot this because this is what you're going to use to find both discount trades and hedge trades. Both of them will come up under the screener. However, I first need to explain to you the differences between the discount trades and hedge trades. It's a very small difference, but very, very important. I know I said that when we're looking for trades, we want to look for reactions from the market. And you might think, well, wait a minute, Raider, if there's too many puts in a market, you said that it would likely cause a reaction to the upside. Say someone buys a put, why would we ever want to also follow that put? Well, that is what a discount trade is. And how a discount trade works, in theory, is that whenever someone who has a put that is intelligent, that fits our kind of thesis, places it on a stock that, again, is unusual, follows all those conceptual bubbles we talked about earlier, he places a put and then instantly you see the markets go against him. That is a sign that the markets reacted to his order. But if it does fit some sort of thesis that matches our own, it can offer a lower risk trade in the future as the market makers have purposely moved it against him to try to rebalance, to balance against his order. Once they're done with that, they let the stock continue to do its thing. So oftentimes you'll get a reaction after that. So what happens is on discount trades, these are orders that are sneaky enough, under the radar enough to not see a massive reaction against it, but they are still worth following on a discount. We wait still for a slight reaction against them, but one that we can still follow at a discount. That's why we call it a discount. We wait for that guy to get punished for his entry, and then we get it at a lower cost or a similar trade and get at a better entry. So the difference is the hedge trade you're betting against, and the differences between the two specifically on Black Box are as follows. I have built this little model for you guys to kind of look at, maybe even screenshot and save. But this right here, where we start at is we assume that we see a flow that meets criteria. Once we find one that meets a criteria, we will go and look, is the contract premium amount over $1 or is it under? In the event that is over $1, what we're going to look at is the total contracts on that order. If it's over 1,500 contracts, yes, it is going to be a hedge automatically. If it's not, then it's likely not a hedge. That's a very simple path of logic there. However, it gets a little more complicated, and we have to do a little math when the contract premium is less than $1. Again, assuming we find a flow that meets criteria. What we'll want to do is multiply the per contract premium, that 0.59, that number right in front or right after the @ sign, and multiply that by the total amount of contracts. If after that you still have over 1,500 contracts, once you do that math, that means yes, it would be a hedge, or no, it would not be a hedge. And again, this is only under when contracts that meet our flow criteria are under $1 per contract. And so to deploy this line of logic again on a different order, we can look at XBI. Now, obviously, this one already meets criteria because I selected it for my report. But you can see right here, aggressive expiration, out of the money, puts, big size, unusual ticker, XBI. Typically, people don't place these big orders on here. And yes, it is a block. There are exceptions sometimes. But what you want to look at is the line of logic. So we found one that meets criteria. Now we look at, is the contract premium over $1 or is it under? And this will help determine what direction trade we're trying to take or what action can be taken from this order. Well, the contract premium amount per contract is $1.5. So that is over. So we're following this line of logic. We go down over 1,500 contracts. Is it? Yes, it's 7,750 contracts. That means automatically it is going to be a hedge order. And as you're doing these, if you ever reach a point where you're saying, no, this isn't a hedge, it's more than likely going to be a discount trade, which means we're likely going to be trying to follow the direction of the intended trade instead of betting against it, which is what we would do for a hedge order. So now that you know the conceptual difference between a discount trade and a hedge trade, a discount trade being a trade that we're actually trying to follow its intended direction, following a small reaction against it so we can pick it up on discount. With the hedge trades, we're actually betting against these trades. We believe they're too big, too aggressive, with too much contract size, etc., that we'll actually expect an inverse reaction from the market makers to either with puts buy up the stock or with calls to sell off the stock. Each of these orders we look for directly impact the underlying stock as market makers are trying to rebalance by buying or selling equity accordingly. So we get to the hard part of this video, which is actually trading flow orders. And I think the best way that I can actually convey this to you and show you which flow orders actually make sense and that have opportunity, I'm going to show you my previous trade plans that I've published on the RADER report. Because not only are these free of hindsight bias because these reports were made ahead of me taking these trades, but also you will get to see the order in its full context with that current market condition. Here's our first example of how flow can be extremely powerful to a trader. Now, again, I'm showing you this kind of in full context because it does matter. When you're going to select flow orders on Black Box, you need to have context that makes sense to the current market. And so this right here, this was a biotech hedge trade. If we do our little checklist, the contract amount is over $1. And so we look at the contract total amount and it's over 1,500. So this would be a hedge order. What also made this attractive, not only is it yellow, meaning it's a dominant fresh order that took over a strike, but also it's on XBI. And this is only from experience, but not many people actually trade XBI, especially with these big $1 million orders. Huge order here, out of the money, very aggressive. And when we looked at this order, I went and I dug a little deeper. What other data supports this? Why would this trade make sense in the current market condition? Well, not only did the markets have a lot of momentum, but XBI, biotechs, typically have a big run up into late January because of earnings. Now, XBI is an ETF. It doesn't have earnings itself, so that doesn't discard it. So not only do we have a positive seasonal supporting it, but we also have this data point to say, hey, XBI could bottom here. When we go and look at the technical chart, this is what I saw. XBI was sitting at this kind of bottom. We had already fallen quite a bit from the top. Why is it that this guy's choosing to hedge now? Why is this order coming in now? He's late to the party. He's already missed a move from 100 all the way down to 86, and now he's shorting? Now he's put this big size on? That is very interesting because why would he place this order so late to the bottom? It's not that he's trying to make a bottom, but perhaps this is the conditions needed, that we've already had a big drop and he's the reason we bottom. So if you actually look at where this guy bought, if we look at the spot price, he bought at 88.16 at 114. So if we go and we draw a line exactly where he bought at 88.16, right on the 14th, he bought right around here. And what you notice is as soon as he bought, boom, next day, a huge gap up. And what you're starting to see is the price hold around this area. This is the start of a bottom. He is physically creating a bottoming reaction because market makers are going to start to have to buy up shares on any decrease of volatility, any decrease of premium. And you can see it went in his favor initially, but this big gap up here is going to crush that volatility. It's going to crush the premium out of those puts, and it's going to start to cause a reaction. So what we said was, okay, this is likely to cause a bottom. The trade's example is quite simple. We're going to look for a move all the way up and through $92. I think that's a fair trade. And so there was a liquidity void between there as well. That's a whole different video. But again, how powerful options are in moving the stock market. And what you can see is right after this guy's order, instantly, a bottom in XBI forms. No, this is not a coincidence. And yes, this is still pumping because of his one order. But if you never looked at options, you would never have any idea from price action alone that this was going to keep going. Not only do we have a buy when, he expires 131, so we can at least be bullish into the 31st of January. But also we have a direction, right? That we knew this was going to be a bullish order. He was late to the party. There was a positive seasonal, and it makes sense that biotechs would see a bottom here because he's so late when this order was placed. All these factors together, including the criteria of the flow order itself, put together a bottoming thesis and trade idea for us. And again, the value from flow is not only direction, that we knew that market makers were likely to bounce against this order. Again, because this put order is so large and so many contracts, he's going to have to manipulate so many shares, and that creates a reaction that he short the shares, but all of a sudden when you have a crush of volatility, those puts lose value, time value as you get closer loses value. So naturally, he needs less hedges. If he short the shares, the only way to exit a short position is to buy back shares. So what you get is a move that is supported directly by the market makers on the way up. This is why we bet against hedge orders, and this is the power of options. Now, let's take a look at another example. This right here, let's see what order it is. You kind of already know from the previous example, but we look at the contract amount. Yeah, so this is under $1, so that would logically make us do that little math thing we'd had. So if it's under $1 and multiply 0.59 by 5,000, that's obviously over 2,500, which means it is over 1,500, which means it's all good. It is a hedge order. We can determine that. So we are going to be betting against this order. Now, what's interesting is, and this is another kind of small thing that you can learn, is that you can see that this guy placed two of basically the same trades, different strikes, but the same exact expiration in the same exact style, same exact amount. Not only that, but he added afterwards at a lower price. When you see this kind of behavior, it adds more conviction to the trade, because not only do you have one big fresh order, again, yellow, meaning he just came down on one strike and just dominated it with big size, but also he added to it, and he added lower, which means he's literally trying to halt the price, not trying to necessarily. This could be a forced trade by an algorithm that's forced to balance another portfolio. But it's ultimately going to likely halt price, because if he's adding lower, he's adding only more juice and more reason for the stock to accelerate to the upside. And so what you have here is BAX as well. This was a healthcare kind of name. And if we go and we look at the time, healthcare was very strong. It was holding relatively strong to the market. So if we go back to the 8th and the 10th, if we go look at XLV here, this had not made a new low while the market had since December 19th. So speaking from a relative strength perspective, healthcare was very strong relative to the market. And so we look at a ticker like BAX, which is in kind of the healthcare industry, we can see that, well, this was also very strong as well. And so when we look specifically at this order, we know it's a hedge order. We see a positive seasonal, and that it typically gets better and runs up into those earnings again into February, late January as well. That adds a lot of conviction to the trade. And I talked about this in a previous video, but how you want to kind of end up to the chart is this kind of order right here. You want to take in a general market context that, okay, we're steaming towards all-time highs. We want to look at the leaders to play the continuation, because that's how rotations work. Markets will favor the stocks that are the strongest to the upside as we break into all-time highs. That being XLV. Healthcare is a very strong sector right now. It didn't make a new low while the markets did. Then we want to look at rotations and seasonals. Is there any good seasonals? You know, things like that. And then we want to end up at the options market, looking at any data that makes sense on these specific names. So in this case, we found BAX. We found that there was a positive seasonal into the end of January with this, and that now we can look at the chart. And the chart also gave a really good idea of when we can take this trade. It has a rounding bottom. It's curling to the upside. It's telling us that it is ready to move, and that betting against this hedge likely immediately is probably the best situation. So what we planned for was any kind of gap up or push into 2950 is going to likely cause a big rally here because of the timing of this order. And of course, when we look at this order, it's not just we expect to pump, but we expect to pump by 117. We have a very specific time window when market makers have to do something, when market makers have to take action, and therefore we can make a game plan before that and be very precise, very accurate as to when we place our trades. We have a seasonal, all this data supporting it. So when we go and we look at the chart, you can see this guy placed an order on the 8th and the 10th. And if we look at this, he placed it at the 8th and immediately on Friday, because there was a holiday, as the 10th as well. And you can see his two orders physically created a massive rally in the market for BAX, for this stock in particular. What I was saying earlier is that flow has a bigger impact on individual names than the broad market. We can be very specific, find orders like this, take that concept of the broad market being affected by options and narrow it down into specific tickers. This right here, one day after he placed these hedge orders, the market starts to rip. Why? Because you had a gap up, a big pump, you start to pump, crushing volatility, crushing, you're only 4 days from expiration here. So these premium amounts from these contracts were going to lose a lot very quickly, forcing the market maker to buy back shares. And what you had was a massive acceleration of price to the upside. This one order created this reaction. If you did not understand or spot this order, this opportunity would have never been under the radar for you. Or let's say you were short this stock and you had no idea that this order was placed, you would have gotten smoked and would have no idea to get out. This is why whether you trade futures, equity, or options, you need to know the options market. It physically moves the underlying. It moves stocks, it moves futures, it moves everything. So I just showed you 2 hedge trades. Let's take a look at another trade. Maybe it's a hedge, maybe it's not, but let's figure it out right now. Right here, is this order something that we should look at? Yes, XBI, that's again an unusual ticker in the sense that not very many people trade it. You don't see a lot of XBI orders throughout the week. And so this is very, very important. And you can see right here, is it aggressive? Is it close to expiration? Does it meet that kind of model that we showed, that little out of 10 box? And you can see he only put 8 days. Okay, cool. That's a weekly. That's definitely aggressive. It's kind of at the money, in the money slightly, whatever. That's fine. And you can see, okay, is this a hedge order? Let's figure this out. Well, the contract amount is over $1, so we have to just look at the contracts. Is it over $1,500? It's not. So in this case, it would likely be a discount trade because it does not meet the criteria of a hedge trade. You can see it's yellow, it's a sweep, and it's 186K, which is around 200K. That's just around where we talked about the sweet spot is between 200K and 2 million. And so when we look at this, okay, cool. This is a really nice idea in the sense that this could be a potential discount trade. Now let's go look and see what the current conditions of this trade were. He placed this on the 2nd. So right here is when he placed the order. He placed it right here, boom, and you can see he placed it 91.19. And if you look at 91.19, as soon as he bought this at 91.19, you can see right here that it had an instant reaction against him. They used him as support and they had an aggressive reaction against him. The key with discount trades is not only do we want to enter when he's around 60 to 70% off. So when his contracts are down around 60 to 70% each, that's typically where you see the sweet spot to enter. So right here, you would want it to see at least below, 70 cents or something per contract for us to really get involved. And you can see right here, instantly, the markets reacted against him. Whenever you see a discount trade that comes in and it's instantly reacted against, that increases the odds of the trade working out in the future. Why? Because it shows us that market makers have seen this order and they are physically trying to balance it. How are they balancing it? They're going short. They're trying to push it against it, maybe to get short at a higher price, a better price, things like that. Hedging is very complicated for them, but that's what we can understand. And so there's a reaction against it. Now, we don't want too big of a reaction, but we want enough of a reaction to discount these trades as we come into expiration so we can follow at a discount. In this idea, I actually went for GILD. This is a holding of XBI, but you could have also just shorted this direct ticker. I thought that there was a better opportunity in this since it was weaker, but you can see both of them. I'll show you in a minute. Both of them had significant shorting opportunities. So this right here, this actually went all the way against him, all the way to $94. And then you instantly saw this start to dump. And this is where you could have gotten involved. When this starts to get weak, coming into the later half of the week is likely when it's going to move into expiration. You can see, boom, there you go. There's the move that this order was trying to catch. But how it works, how the big money game works, is that most of the time when you place a big money order, your timing is going to be physically built against you because big money makes it harder to time because when they place these big orders, the stocks move against them. And especially for a ticker like XBI, which no one trades, it's going to likely punish that guy for a little bit before actually working out. So in this case, you can see how much it worked out in the favor once you saw a discount, again, between 60 to 70% off. I went ahead and I just shorted GILD, which instantly started to bleed off following that. So I caught a nice move here. But again, this was just a weaker stock. It's trading the same idea, but on a different ticker. That's called a sympathy trade. And that's something I do often do based off whether I think this ticker could have a better opportunity or a worse one than the one that the flow actually came in on. So again, this is a discount trade. And you can see how we went from capitalizing on a discount trade on XBI to the next week seeing a massive hedge order that actually created the bottom in XBI. So 2 dynamic orders that created opportunity just into a 2-week time frame on that stock. So let's take a look at another flow order so you can continue to build this kind of concrete idea in your head. So first of all, this one is on Roblox. Now, before I show you that, I want to build everything in context. And the reason I'm showing you the context of stuff is because it's incredibly important in determining what flow is actually useful. For example, let's say the markets are tanking right now. and we expect that, well, seasonally next week starts to slow down in that selling pressure, then you probably want to look at flow names that are kind of betting on that idea, that are betting that would somehow trigger an idea, whether it's a hedge trade or maybe it's a discount trade on something that is actually to the upside, or maybe even a continuation down to the downside once that slowdown starts to ramp up again. So you're really going to have to build this bigger context, and I do that in the RADER report. So I kind of show you guys my entire trading thesis. So for this week specifically, you had really good seasonals. There was a Monday and Wednesday that were really positive. You typically see a lot of bullish price action in that. What also was very interesting at the time of this trade is that markets were steaming towards the highs again into late November and early December. So we're really looking at bullish ideas. Well, if we continue to break out, what is going to move the most? What could we possibly catch that would have a nice big bounce? And this Roblox really made a lot of sense to me. And why is that? Well, let's take a look at this order. So this right here is Roblox, and what you have is 11/21 is when he bought it. So he bought it right around here, and he has 12/6 expiration. Again, that's not a monthly expiration. That's very aggressive. And you can see it's spread across 3 orders. And these 3 orders, while they're only 130K, 170, and 371, these together come to about 600, 700K almost. So this is a very interesting order that we have to look at, because that is a lot of money for something like Roblox and very unusual. And like I said earlier, that once they add like this, once they're adding multiple ones, boom, 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 that is very aggressive. So we need to first determine if this is a hedge order or is it a discount trade? Is it something that we're trying to fall? Well, it's a put, first of all, and it's at around $1.30 per contract. So is this over $1? Yes, it is. So we look at just the total contract amount, and you can see this one's $1,300. That is technically not a hedge order. It's very close to it, but not a hedge order. But because he placed 3 orders, you would add these all together. So you have one that's 3,000, 900, and 1,300 altogether. That is obviously well over 1,500 contracts. Because it is the same trader, we can just attest it to being the same position, the same kind of idea, the same orders, all being yellow, all being aggressive and placed new on a strike, dominating that strike. So this is a hedge order, and we are going to bet against it. And so what I did was I said, you know what, look at this. We don't necessarily want to bet on an instant reaction, because Roblox has quite a bit of momentum to the downside. But where I'd be willing to kind of step in is around his strike that he got, 48 and 49. You can see 48 right here is the start of my buy dip zone. Right when a contract gets at the money or slightly in the money, that is when the theta decay and kind of that extraction premium is the highest as you near expiration. So I was kind of betting on that, well, if we get down to this level and we kind of chop around here, this is where the effects of options are going to be the highest, that you're going to see the most extraction from premium. Because remember, an at-the-money contract has the highest theta decay as you close in to a expiration. And so what you can kind of see here is, boom, you want to see a bounce into that. And what happened to Roblox? Well, you came down into this $48 level, you bounced. This is where I started to buy the dip at. And then you can see as we started to chop higher, we got closer and closer to expiration. All of a sudden, you had this massive gap up. And this massive gap up crushed the premium of this order. And what it did was the market maker was short, but all this buying pressure was starting to trickle in because so much premium was being extracted from these puts, because the market maker was short. He's having to now buy back shares. It creates this chain reaction. And while it's not all the market maker doing this, it causes that frenzy, that the initial move, that big surge is all that it took with the context of the market in mind to make a big reaction. You can see after this, into expiration, the market's absolutely pumped. And if on cue, you guys can see, on the day into expiration, you see a massive selling of options, because what happened was the market makers bought all these shares. As they near expiration, they now need to start leveling them off because the market maker is really long and he needs to get back to delta neutral. So what is he doing? He's going to start, and of course, naturally, people are piling into calls here. So he's buying and buying equity. Now he needs to offload it into the expiration. So that's why I can't stress this enough, how important it is, because not only did we get from this Roblox idea a win, we got a buy 12.6. We expect this move. Well, if you go look at the dates, you can see buy 12.6. We caught that move. So we have a time window. Many of you don't know when to actually long something. Many of you don't have a time window. and knowing when the markets are going to move is over half the battle. What also kind of added to this thesis was Hindenburg Research, actually back here. They released a research report that was very emotional, very unintelligent in my opinion. It was accusing them of having child predators on their platform and how that's bad for the business model. It had nothing to do with the business model. It was just them attacking the platform for maybe a lack of censoring these predators. But it's Roblox. It's going to be hard to do that. It's not worrying the investors who are actually worried about the business, how much money they're generating, etc. They can always fix these problems. It's nothing new. And so this actually had a huge surge off of that into earnings. And so you were actually curling around after those earnings. We had a huge kind of thesis that mid cap and small cap names would start to do well ahead of the Fed pausing and things like that. Coming into late December, you start to see a big rally in a lot of small cap names. Typically December, small cap cryptos, small cap individual names typically have big moves. So those were all adding to this thesis. We happened to see Roblox. Roblox fit the narrative. It fit the glove. And that's something that we traded to the long side. But again, guys, the power of these options to not only know when, but where these moves are happening is a game changer for many of you. So now that I've shown you pre-selected examples, we can actually run through Black Box, show the screeners, and actually find some real ideas as of, January 24th. So with that being said, here are the filters I'm going to set. I'm going to have stock on. I'm going to have these two, yellow, add above ash, sure. I'll have all these. I'm going to select my filters from the 24th to the 14th because I want to see everything but the monthly expirations. And then I'm not going to have sweep check because I actually want to see some block orders. And I also have this historical check down here. I'm just wanting to see from Thursday to Friday. And so we can look at the last 2 days. And I'm actually going to go back to Thursday. We could start here. So as far as the orders from top to bottom, this is too small. It's 30 strikes out of the money. This is not something that I want to look at. Likely an earnings trade just with how it's placed. Let's go check. CHTR, yes, this is going to be an earnings trade. You can actually, once you get good enough, you'll know what kind of earnings trades likely look like. Moving up here, 635 strike, way too out of the money. Also probably some sort of earnings trades or something. GME, just something I want to stay away from. We don't like to trade stocks like GME, especially since the option flow is quite meaningless because it's such a heavily shorted stock and manipulated in a lot of retail names. I don't like looking at it. ELF, this is interesting. 10 strikes out of the money, but ELF 110K is not that much. We can go look. This might be an earnings trade as well. Yes, it is, just because of how far out of the money it is. Again, typically you can actually spot whether it's an earnings trade or not. Netflix just had earnings. I'm not going to do this. This is likely someone trying to chase something. It doesn't mean much for the current market context. HUM, this is interesting, but again, this looks like another earnings trade. So we're going to go look and see, verify. Yes, it is. February 11th is earnings. And he got the 24th. Oh, wait, no, this is not an earnings trade, but he got the next day and the next week for the 300. But I'm going to say that this is overall just not a good order either because 120K on HUM is not very much. So we're just going to skip that. Disney, probably nothing here as well. I don't like that one. Too small of an order. INTC, nothing here. HUM, again, just too small of orders here. Nothing. They're meaningless. I don't necessarily want to look at those. MRK. Now, this one is interesting here. We can go click on MRK. This is actually interesting. 97 call. This is a healthcare name. It looks to be a discount trade. 131. It's aggressive, and this could make sense. Let's go check out MRK. Again, healthcare is very strong right now. This is coming into earnings. However, he didn't get the earnings strike, which means he's probably targeting some sort of earnings run-up or something like that. So we have an order that's coming into earnings, but it doesn't go through earnings, which means, well, wait a second. Why would he buy an option that expires before earnings? It's probably because he's trying to target some sort of earnings run-up. So this is actually a decent idea. And you can see we're consolidating. We have not made a new low. So how I would likely play this is that really any gap up into this, so any gap up into or above. And the reason we want a gap up is because gap ups create that kind of crush of volatility. It creates that kind of movement. When you see a gap, it invalidates a lot of resistance areas and you get to see that free, uncontested move. So in this case, this is a call order. We would likely want to see either some sort of discount, some sort of chop down and then a pump, or since this is so small, it's so sneaky, it's only 100K, we could certainly see some sort of move right now going to the upside. So this is something to look for. It's interesting to note this as well, 124. This, of course, expires today. It doesn't really mean much to me, but this right here is something interesting that I'm going to look at. And so I would say long anything over 96.55 here, targeting an earnings run-up, which means that typically before earnings, you actually see a lot of positive price action because there's more market participants getting hyped, buying in, wanting to participate in earnings, which creates buying pressure. And again, why would this order kind of make sense? Well, given the context of the market, we can look at a few different data tools that I have on the RADER report. First of all, seasonals. Healthcare probably gets a decent seasonal around this time. We can go look at MRK. You can see, yeah, it typically does. Let's go look at post-election years, 10-year. You can typically get kind of some bounce into end of February into earnings, sure. So this is something that necessarily doesn't give us a whole lot of data, but something definitely worth looking at. Additionally, we could go look at the options chains and see, is this super heavily shorted? Because if it is, it could be enough to actually see some sort of big movement on. If you actually look at the 221 expiration, the next monthly, this is pretty heavily shorted. I mean, 20,000 contracts on the 95 and the 90 strike. This is some pretty big put walls that also could support price and give us a reason to to see an upside move. So this is definitely something to look out for. MRK, I like this one. It fits the bill of healthcare being strong, biotechs being strong, coming into late January is February. It's something that I'm definitely going to long. Okay, moving on from MRK, we go to RGTI. This is not something I'm really interested in. $13 stock. Could it be something worth? It is a hedge order. It is 470K. Let's go look. Do they have earnings? RGTI. Let's go look. No, they do not. This is interesting. Okay, so we move into a stock that is like a pump and dump. Could this be another reason to go higher? Maybe, but I don't like trading $14 stocks. These really, really cheap, lower market cap stocks, you get to the point where it's so cheap, so low market cap that these options can be very wonky and not give the same kind of effect you expect on more liquid, slightly more liquid names. So Trip, I'm not really interested in this. This also kind of looks like a little bit of an earnings trade. Let's go see if they have earnings. Trip, yes, they do. So this would be an earnings trade. They've already had a huge move as well. I don't want to look at Flow after a huge move like this also, because that's also someone who's probably chasing price, who's just trying to get in, things like that. It doesn't mean anything. Or some balancing order we are never going to understand. So that's that. Hall, not interested, too small. SLB, too small. 100K. Char, not interested. APP, this is interesting, but it is in the money, and it's 214. I don't really care about that. AXP, don't really care about this one either because this is 345, 20 strikes out. This is probably another earnings trade as well. And again, you will just get used to this. Yes, this is also an earnings trade. They had earnings today, so that's not something we want to look at. Moving on, BAC, not interested, too small. EA, too small. Any Adobe 221. Okay, so this is interesting. I don't think they have earnings. Let's go look at this. Adobe, do they have earnings? No, they don't. This is a really interesting order. So check this out right here. So you have an order, and it's the 447 strike. So he's targeting this right here. And what's interesting about this is that this seems to be targeting some sort of gap fill. He bought this on the 23rd, and you can see 447. Is this a hedge order? Let's see. Contract's over $1. So we look, is this over 1,500? No. So this would be a discount trade. 220K is quite a bit for Adobe. That is certainly quite a bit. It is a block, but that doesn't matter. We're still yellow. Good. So this is a nice trade. And what I like about this technically is, check this out. You had this massive sell-off. He didn't buy right here. He didn't buy right here. He didn't buy right here. He waited till the slowdown and chop right here to buy. This means it's likely some sort of bet that Adobe is going to start to run higher and that we've already had max pain. Max pain being the biggest point where sellers kind of liquidated, everyone got out, and now you can see this instant change in dynamic that you went from just going straight down to all of a sudden, boom, straight up. So clearly this was a max pain point, and he's probably betting on some sort of C leg, final leg up, final big move higher. So this is an interesting one. Are we going to wait for a discount? Possibly. We could wait for a liquidation and then buy back as it comes up here. That's a possibility. In that case, I would probably buy a 422. I'd be a buyer there. He did get the 131 expiration. So not too much time. He only has 5 days, given that he entered on Thursday. So any gap up as well, I'll set a condition that because this is the gap fill, any gap up into or above the gap fill, I'm actually going to look long. So your entries here for this order would be 440.94, as well as buying the dip off of likely 425.85, somewhere there. So we have a buy the dip scenario, and we also have, if it gaps up immediately, to follow right away, because market makers are just going to let this run, or the markets in general are going to let this thing run. Not necessarily the market makers, but remember they are buying shares with this order as well. So it could create an instant reaction in the favor of the direction. Because this is a discount trade though, we often do want to see a small reaction against him to see some sort of balancing act that maybe they want to buy it at a lower price, things like that. So typically, while I would say the preferred scenario is to buy the dip down here, 426, the reality is you just don't get the dip all the time. So I would say either buy the dip there or on any gap up here, you would buy above 441.20 or 442.60, somewhere here to target around 448 to all the way up here to 459. And again, if you're confused how that idea kind of snapped in my head relative to all these other ones, it's just that they fit the narrative. They fit the bill that these beaten down stocks like Adobe are going to be the better names to long as the market kind of struggles to break into all-time highs. It might chop around all-time highs. In that case, they'll rotate from the leaders to the laggers and buy the beaten down names like Adobe for that less resistance move to the upside. So while I can't exactly explain why necessarily this order is better than a lot of other ones, it just takes experience. They're not in earnings. It's not a news trade. It's just a name that's kind of under the radar. It's a name that makes sense in the current context of the market. And it's something that we can also kind of find other data on. If you go and look at Adobe, you could pull up like an option chain and see, is this heavily shorted? Hey, it's a little bit of mix of both, not too crazy, only 2,500 contracts. It's not a highly traded name. If we go and look at the seasonal, does Adobe typically get a run up into this? Yes, look. So Adobe seasonals typically have positive sentiment into the 27th all the way to February 4th, which coincidentally could match kind of that discount trade that we drop into the 27th and we bounce all the way into the 31st, which coincidentally, again, would match the idea of this being a discount trade, buying the dip, and then getting the rally into the end of the month, into the beginning of the next month. Now, the last thing I really do want to talk about that is really relevant to flow is that if you go and buy black box stocks right now, you use the filters and you try to look for orders, you will not find anything good. And the reality of it is because you need to be a market mechanic trader. You need to have a perspective in technicals. You need to have a perspective in seasonals, rotations, everything else will contribute to how good you are at interpreting flow. For example, if you suck at charting and you don't know, for example, my charting system, then you're going to suck at knowing where to actually enter for a discount, or you're going to suck at knowing that the stock has too much momentum. And even though there was a hedge trade placed, it's better to wait for a dip closer to the expiration for that market maker to then start getting squeezed and starting to buy back shares. So technicals matter, seasonals matter. Like, for example, if we're in an October bottom and you start to see hedge orders to the upside, those probably aren't going to be the best to bet against in growth names, especially because markets are going to start rallying higher likely out of that bottom, and those hedge orders will likely work out even though they are a hedge order. We have to understand context of these orders. We have to be able to build this framework, and I'd like to think that I can do that in the RADER report and show you guys throughout the videos that I've posted on YouTube here that you guys have access to. I am a market mechanic trader, and to take advantage of this machine of the market, you have to understand multiple parts of it. For you to understand how a car drives, it's not just the engine that makes it go. It's the axle, it's the drive shaft, it's the wheels that all contribute to a profitable system and a car that moves. And that is 1 hour of brutally complex flow topics. If you made it this far, you might be a little confused, but maybe you're feeling a little bit excited, like you're on the right path and you understand many of these new concepts. That's great. That's exactly where you're supposed to be. Just into trading, I've put probably well over 10,000 hours since the age of 15 under my professional mentors into learning this stuff. I'm almost 21 now. I've never drank alcohol. I never smoked, and I never have gone to a party. This level of dedication is what's led me to be where I am today at my age. So if you are wanting to learn more and you are wanting to solve some of that confusion, you can get a lot more access to these materials by signing up for the RADER report down below. This is where I post my professional research between weekly reports, seasonal reports, even monthly reports on a longer time horizon with live data tools. I explain my entries, all the flow I find relevant to the markets and have edge, I post as well in there. It is a complete market perspective. You will get to see exactly how I am planning to trade the markets moving forward. And believe me, the level of accuracy and professionalism you will see nowhere else. Additionally, within the next 2 weeks, I'm going to be opening up my private Discord that I have had private for the last 2 years with my professional mentors up exclusively to the RADER reporters. So if you do sign up for the RADER report in the next 3 or 4 weeks, or whenever you do, you will get an opportunity to access this Discord, which houses tens of hours of flow content from PDFs to pre-recorded lessons from my professional mentors who were semi-retired but still love the markets. And if you're wondering why they do it, well, it's because I drag them along and force them to. They love the markets equally, if not more than I do, and I believe that I can create an impact with my audience to better inform traders on how the markets actually work and to better give them the toolbox they need to succeed. None of this golden strategy BS is sold on the internet today. This is a real industry that requires real academic intelligence and real people to be committed to it. And I believe a lot of you watching right now are probably those people. I look forward to seeing you guys in there. Have a great rest of your day. If you have any questions, drop them down below. I will answer to the best of my ability without typing up an enormous essay. Other than that, guys, have a great day. Bye-bye.